Hello, everybody. This is Doug Curtis with Keller Williams, the Curtis team at Keller Williams, and Josh Sigman, the owner of the Sigman Team over at Legacy Mutual Mortgage, my go-to guy for all things related to buying, getting a mortgage to buy a house. So, Josh, tell us a little bit about your background and what you guys do.
I've been in the business since 2003, I guess. So we're a full-scale mortgage lender. We're actually one of the largest local wholesale lenders in San Antonio. And so what we do is anything that's a 1 to 4 family residential loan, primary, second homes, investment properties, construction lending, basically full-scale VA, FHA, conventional loans, you name it, we can probably do it. But that's what we specialize in. We're just really help people get into homes or refinance their homes.
Awesome. So in a normal environment, we close in 30 days. Typically, somebody with a 600 credit score can get a loan, right?
Well, things are starting to change a little bit, but yes, in general, 30 days is no problem. As far as credit scores, one of the things we're probably going to talk about is that some requirements of banks are tightening. And so 620 credit scores currently is where we're seeing most of the industry for a minimum. And I do expect that to tighten up more and more. But right now, 620 is a minimum credit score in the industry for most banks.
620, and you expect that to go to 640?
I think, so depending on which article you read, I think that the industry standard will probably land at about 640 when it's all said and done. So there are still banks that are doing lending with lower credit scores. What we're seeing in those banks is that they're starting to raise the interest rates or the fees to kind of adjust for what's called risk-based pricing, higher risk, higher reward to the bank. But what we think is going to happen as an industry norm over the next couple of weeks and months is probably land around 640 as being a kind of a new standard for government loans.
So if I'm sitting here today with a 625, I should probably do something before things change too much.
Right. I think that's really sound advice in general. When you're really thinking about what's happening with the market, to give some overview or color for anyone that's watching, what's happened to make this super simple is when the stock market drops really fast, the rate market drops with it. Okay. The problem was good and bad is the rates got so low so quickly that back in early March, investors that are freaking out with the stock market dropping would normally take money from the stock market and go buy safer investments like mortgage-backed securities or bonds or T-bills. And when the rates got so low, and now there's talk about wide-scale unemployment, forbearances are becoming an issue in the industry as well. Investors aren't buying or looking at those mortgage-backed securities as safe as an investment. And so now what they're doing is saying, okay, well, if I'm going to invest in the market, where do I put my money? And they're going to take safer bets, just like a normal person would. You'll put money with a more down payment, a higher credit score, a more normal sales price or type of property. And that's why you're seeing that kind of constriction in the marketplace as a whole, as far as whatever the lending box was 30 days ago has just shrunk a little bit. So to answer your question directly, yes, I do think it'll shrink further. So people that are thinking about buying a house in the next couple of months or within the year, I would absolutely encourage to at least go meet with a lender to discuss it, because if you're marginal in credit for sure, you have time at least to work on it to get it to where you might be, or to jump on. You might be just fine right now. And the other thing I'm seeing right now is that it's an unbelievable opportunity for people to buy, in my opinion. For buying and selling both, I look at it very simply. Right now, people are scared to death of COVID. I get it. It's a real thing. That means as a buyer, they're competing with fewer people. So the people that are buying houses right now, we're seeing sellers more willing to negotiate than 90 days ago. On top of that, rates are the lowest that they've been in a decade, right? So now they can get a lower payment on that new house. And then on a selling side, though, there's still a lot of pent-up demand at this time. Whether that demand will be around in 6 months is different. But as a listing agent, you know that houses are still going for pretty damn close to full price. And so it's like that perfect storm where be greedy when people are fearful and fearful when people are greedy. Right now is a really great time to buy and sell. So if people are thinking about doing it, it's a good time to do it.
It's an interesting market, at least in San Antonio. On Sunday, a house hit the market we went and saw it that day and made an offer 5,000 over list because we knew it would not stay on the market. Somebody else made an offer 6,500 over list and we didn't get it. One day on the market.
Yep.
So people are still buying and selling for sure. So I know you don't have a crystal ball, but what do you think is going to happen with the rates over the next 30, 60, 90 days?
Great question. So I would say the majority of loan types, not all, but the majority of loan types, I think the rates are going to stay low. I think that most economists nationwide will tell you the same thing. In general, when the stock market goes down, rates go down. It's not always happened that way, but clearly the stock market's down. And there's a couple other economic reasons why they should stay low for the majority of the year. The reason why I put an asterisk though on it as far as most loan types is what I was explaining earlier with that constriction of loan types availability. So, when you think about what is considered a safer bet, it's a house or a loan that the majority of people can buy. And so, San Antonio, as an example, has an average sales price of around 275, somewhere depending which book you read, 250 to 275. So houses that are selling in that 100 to 400 range have the most loan options between a VA loan, a FHA loan, or a conventional loan, right? Or a USDA loan in a lot of cases. And so my point is that if a bank had to take that loan back, God forbid, because they had to foreclose, it's easy for them to get rid of it because the majority of people can buy it, right? But when you start looking at a jumbo loan scenario, that's an area we're seeing rates go up, not down right now, because there's not a whole lot of people in any city that can afford the top 2 or 3% of all values of houses. So the $1 million houses, the $2 million houses, those rates and fees are going up right now, not down. And I would expect that in the near future, because as banks worry about and predict more foreclosures, more forbearances in the future, they know that if they take back a house, they don't want to take back a $2 million house because there's just fewer people that can take that off their line, right? So those tertiary, the second homes, the mountain homes, the ocean homes, the jumbo lending, and then like I said, the very low credit score kind of stuff, you're going to see rates and fees go up in all those tertiary areas. But for the most part, a standard buyer buying or selling that sweet spot, $200,000 to $500,000, $200,000 to $600,000 range, they're going to be pretty safe and rates will be pretty low for a while.
Yeah, awesome. So pretty much the way things have been for the last several years.
Yep, absolutely.
Except we sanitize the handles and everything and touch nothing.
Well, it's funny. So we're on this video conference, and really right before I got on, I actually hand sanitized, and I'm sitting in my bedroom. I found I've got this weird tick. I do it before and after every Zoom conference. Yes, it's bizarre, but I'm actually doing it. Super weird.
You didn't shake my hand, so.
That's right.
So you guys help out the guy that has the 600 or the 620. You guys can give them a plan to help.
Yeah, absolutely. Absolutely. So, and it's not just us. There are a lot of great lenders out there, but there's software now that can give a realistic time frame to improve a credit score and what would be required, whether it's, pay down a debt, $1,000, or open a new line of credit or close a line of credit that you have. And literally by pulling the credit one time and for free to fix it, we can give a client an absolute plan that, if followed, gives kind of like that prescription of, hey, in 90 days, if you don't miss any other payments and you do A, B, and C, you'll have that credit score of 620 or 640 or 660, depending on the loan program requirements, a real time frame to do it. And so that's why I was saying, if people are thinking about doing it, in this environment, you don't want to wait till you're about to make a house offer in a house, because like Doug said, like you said, the best houses go full price and right away. And so you need to have a real pre-approval done ahead of time. And that's the second piece of the puzzle. So let's say that you inquire early, you find out you actually do qualify now. Well, what we would do is I would recommend everyone with their own banks or with us to take it a step further, of not just get a pre-qualification letter, you should get a pre-approval letter. And really simply, the difference is obvious. The pre-qualification is that you tell me that you make X, you have this much money in the bank of Y, and I know your credit score is Z. So based on your verbal income and assets, I can tell you, yeah, you qualify for $300,000, okay? But a pre-approval means You now send in paychecks, you send in bank statements, you send in tax returns. And now as a lender, I can certify a commitment letter stating that I have verified this income, assets, and credit, and we can for sure close. And so as you know, as a listing agent, Doug, that if you get an offer on one of your listings and it's a multiple offer scenario and 3 of them are pre-qualifications, which mean nothing in this environment, and one's a pre-approved, certified, this deal is going to close, you as the listing agent are going to counsel your seller to take that offer over the other ones, or at least look at it more strongly, which is why people will win in a multiple offer scenario or even at a lower price than other offers based on that, the strength of that letter and who it's from and what's, what's been verified already. So I would say do it for credit for one, but do it also to be prepared to make an offer if you find the right deal, because what will happen, unfortunately, when people are furloughed and laid off, people will lose their houses. A few people will lose their houses. And that's a really sad state of affairs. And it happened. We saw it in 2007 and 8. And that also opens up opportunities for some people to buy houses, right? And the deals are going to be few and far between, but there will be deals to be had. And so waiting to the last minute to get approved in this environment is not recommended in general.
So logistically, how are you guys operating? Are you doing Zoom meetings for the initial interviews? And
yeah, that's a great question. So I'm working on my bedroom. It's my new norm. It's strange. I've got 3 kids, 12, 9, and 7. My wife has turned into a full homeschool teacher. I'm super proud of her. And yet we're business as usual. So banking and mortgages are considered a essential industry. So we've had everyone work from home for a couple of weeks now. We do a basic pre-qualification over the phone or by online application. And then I like to meet with everyone face-to-face. So now we do face-to-face meetings through Zoom and kind of talk through goals, kind of work through problem solving, how to make things work, whether it's now or in 3 or 6 months, and get things rock and rolling. I've always found that once you can be okay and understand and be comfortable with what's your payment going to be for 30 years or 15 years, and how much cash do you realistically need to have the day of closing. If you're okay with those 2 things, this should be an awesome time to go find some real estate. It should be less scary. In fact, you should enjoy, buying the most expensive pair of shoes in your life, right? It's not every day if you go blow $300,000, you should enjoy it. So I try to remove the fear part of, I wonder if I qualify, do I qualify, what's it going to cost me? And once that's out of the way, then, you get to do the fun part of helping people find the right home.
Right. Yeah. And we've been busy, so I thought things would slow down. We've had a few clients pull back, but generally we're still trucking along and trying to make a difference and be the counselors that the clients need.
Yeah, it's super interesting. I thought the same thing. I thought that when people started staying home, it'd slow down, but we have actually not seen that as an industry. Nationwide, loan applications are up. Yes, there's some refinances in there for people that are staying in place, which makes sense. But what's really interesting is people that are looking to buy are serious about buying right now, or they wouldn't take the time in this environment, right? And that's really good news for sellers because they have fewer tire kickers. If a seller has somebody coming in to look, they're probably really serious about buying right now. And that's what we want. We want people that want to buy and want to sell. Makes the process way cleaner for both parties. And we're seeing a whole lot of that. So I'm just super optimistic about the next 90 days. Past that, who knows? I guess it's how, whatever happens with our economy further. But I don't think it's going to be near as bad as 2007 because our economy was robust going into it. It's a big difference. And that's things that the media is not picking up on yet. You can't compare the two. There was a fundamental bad banking practice going into the 2007 market downturn and eventually the mortgage market failure, right? It was due to real problems, underlying issues. Going into this stock market crash, the economy was kicking. It's about as healthy as it's ever been. So the best analogy I can give people, because I really do believe this, obviously the longer people have to stay home and the longer it takes to get the economy kicking, the longer it'll take to recover. But the difference is that in 2007, you had an 80-year-old that broke their hip. 80-year-olds don't recover that fast. Here in 2020, with a robust economy, you had a college athlete that works out every day that's super healthy that broke their hip. They're just going to recover faster. And so, yes, there'll be some strain. Yes, there'll be some heartache. Yes, there'll be some loss of life. Yes, there will be some loss of jobs. But the optimistic thing that I think people need to understand is that we are feeding the problem or feeding the solution. And the problem is fear mongering and keep on saying how bad it is and if the world's coming to an end. And we've got a lot of historical reference to go back and say, it's bad, but it's not near as bad as it's been in the past. And I can honestly tell you that I believe that we will recover far faster, and especially in our local economy here in San Antonio. People need to remember that as a city, the housing market never crashed in San Antonio in 2007. Like, we didn't appreciate, but we didn't depreciate in the worst environment ever. So a bet on housing, if nothing's ever a sure bet, but I'll tell you myself, I am an investor myself in real estate. I have purchased 3 properties in San Antonio, knowing what I know about the environment in the last 90 days. I've personally bought them. So I am very bullish about rental properties for investors, about ownership of real property here in San Antonio. And I'd really encourage people to not feed into this, the world's coming to an end. And yeah, it's different. I'm working on my bedroom. That's not very professional. I don't like it, but it's not the end of the world. And business is going on. And I would encourage everyone to keep on focused on the good side of things, not the bad.
Staying at home saves a lot of gas.
Absolutely.
Especially that drives a big truck.
Absolutely.
So Josh, one thing you didn't mention is you don't just do mortgages here in San Antonio, but you do them nationwide, right?
For the most part, we do them in about 24 states currently. Although I do have a network of people that I know nationwide. So if somebody needs help in a different state that I don't serve, I can absolutely refer them to a very well qualified mortgage lender. For the most part, currently we're mainly in the South. Mainly you take me from South Carolina all the way over to California, south of Missouri, and pretty much we've got it covered. A few exceptions in the Northeast, but yep. I'm a born Texas boy, so we primarily serve Texas, but Nashville, we've got a group of guys that are crushing it there. Denver, we've got a group of guys crushing it there. All over Texas. I think we've got 16 branches all over Texas. So here to serve for sure.
All right. So I'm enamored by the presentation. So I want to start doing business with Legacy. What's the best way to start the process? Go to your website?
I appreciate the question. Yeah. So believe it or not, I'm the owner of one of the 2 owners of the company, and I will take your personal email. So you can always email me, josh@legacymutual.com, josh@legacymutual.com. If you'd like to Facebook friend me, we've got the Sigman Team, SIGMAN, the Sigman Team is our Facebook business page. You can connect there, or you can call me. I will actually take calls and respond, 210-287-9119. It might take me a little bit to get back because I'm back to back, but I'll always call back. So I appreciate the endorsement there, Doug, and I'm happy to help.
Awesome, Josh. I appreciate your time. And as always, it's a pleasure talking to you.
Yes, sir.